Hello, hi, financial analysts and the lovers of financial modeling, data visualization. You're most welcome. Let's do these things together. I'll be looking at a number of things. Among them would be to just look at how to do a forecast, and which then can be developed into a plan. Most people think that a forecast is a plan. A forecast is not a plan. A forecast is merely a prediction. All it does, it draws from the actuals and use the trends into giving a picture or a futuristic picture. So it is not a plan. I was privileged last week to train a group of professionals from West Africa. At least I've had an opportunity. I've trained 2 groups so far. I had an opportunity to train those people in financial analysis, forecasting, modeling, data visualization. So it's quite good. But like I always do, I always want to use the actual data so that people have the real industry effect on how to do these things. So I got the audited financials for 3 years from their website. Obviously, it's free of charge. And use those figures to develop a 5-year financial forecast. I must actually mention that I didn't have any other data apart from the data that I got from the financials. I would have loved, if I'm analyzing on sales, I'd have loved to analyze sales using volume and price, which in this case should have been a tariff. But I didn't have that information. So it was quite a bit difficult, but still I used the audited financials and still gave me the picture that I needed. I think I'm still closer to what I could have gotten had I got the other data, like on volumes of electricity being sold, the number of customers and all that. And unfortunately, the audited financials don't do that. And how to recommend companies to start preparing integrated reports, because integrated reports will give an analyst a lot of information that would otherwise be absent in the audited financials. So this is just an independent analysis on this. I couldn't mention it because they are my clients. So I was given an opportunity to train them, so I would not mention the name of the company. So as you can see, these are the audited financials. This is 2016 to 2017. I got from 2015 to 2018. This is their what you call statement of comprehensive income, which is profit or loss, and the statement of comprehensive income. You're safe just calling it an income statement. Yeah. So you can see on the revenues against the cost of sales. Apparently, the cost of energy was about 99%. That is too much, I think. Meaning that it was about 98%, meaning that you have only, is it 2%? No, 99.8%. You have about 0.2% that you can actually use for operations. I thought that was a very tricky one. I think they're in a very tricky situation. Their costs down, their administration costs, they are not that much, and you can see the efforts that they're actually putting in reducing these costs. But what is killing them is the cost of sales. So I don't know how this company, and this company is a private company, I don't know how it's surviving. But what I saw really was on the government grants, like the government is giving them quite a number of grants, if you check in their balance sheet, just to make them survive. Otherwise, they are in serious problems. You look at their trade and receivables, you look at their inventories, very low to the equivalent of 4 days. And I will be explaining why that is the case. Then you have the trade and other payables. You can see how it has actually grown. It's quite scary, very scary. So this is for 2017-2016. And see the problems actually still there. I mean, if you are left with a headroom of less than 3% on gross profit margin, then it becomes tricky. If it's just an other business, it would actually close. But electricity is a public good, and I'm sure their government is trying so hard to keep this business afloat. But maybe the best way would be to give them room to increase the tariff or reduce the cost of purchasing energy. So this is their balance sheet for 2017. You see on the details on their revenue. Their prepaid customers is just about 4%. So they have postpaid customers of about 96%. Meaning they have a very huge task to collect whatever is owed to them. They have a very huge task. So I wish they can just speed up or roll out their prepaid meter project, and that is going to greatly help them on sorting out the receivables problem that they have been having. But the area of interest is on the cost of sales, because the direct costs, as much as you can be able to reduce the other operating costs down there, the indirect costs, these are costs that are not directly attributable to the cost of distributing this power. Admin costs, name it, those costs are quite easy to reduce. Unlike cost of sales, because the direct cost, you can only remove the excesses, but it's extremely difficult to reduce the cost of sales. Imagine the cost of energy, which is over 99% of their revenues, meaning the 100 naira that they actually make in revenues, about 99.8 naira is actually going towards purchases of electricity. So they remain with only a headroom of about 0.2%, when ideally in this industry are supposed to have about 65 to 70% gross profit margin. They're giving them an EBITDA margin of about 30% somewhere there, which certainly they can't have, because if you have an EBITDA margin of say 3%, then it becomes difficult. How do you actually finance your projects? How do you actually pay interest and all these other things? It becomes extremely difficult. And folks, it's the best way to analyze this. When I look at financial analysis, and I've always told my colleagues that you can only be in a better position to analyze the financial statements or the financial position of the company if you understand the double entry. So if you don't understand double entry, it becomes extremely difficult, because these things are connected to each other. I'll give you an example. Property, plant and equipment is connected to revenue, because it is those machineries that help you to generate the revenues that you need. So if you do an analysis on property, plant, equipment and revenue, you would be able to discover the levels of active assets that you have that are able to generate revenues. And to a greater extent, again, you'll be able to know the levels of lazy assets. So if you're in an organization of lazy assets, they'll not give you the required revenues that you need to expand your business, and also to give part of your successes as an organization to investors in terms of dividends. You'll not be able to do that. So you can see the expenses, they are quite low. They have managed to reduce them. So the lesson here is that as an organization should actually be able to know the optimal levels of cost that they can absorb to efficiently run the organization. So coming up with austerity measures is key. But I think before organizations decide to institute austerity measures, it's need for them to determine what will be the optimal cost to run the organization. Otherwise, they might actually be eating into the optimality and leave the organization a bit vulnerable. So if you check on this organization, you cannot advise them then after you've seen the numbers and you say, because you are a financial consultant, and you say they should reduce administration costs or indirect costs. How do they reduce them? They already reduced. The problem is on the cost of sales, whose cost of energy is 99.8% of the total revenues. So it's quite weird. Like I'd already mentioned, a forecast is just basically a plan. All you're saying is that you expect there will be rains. So what's the plan? The plan maybe is to have an umbrella. If you have negatives down there, of negative EBITDAs, the forecast showing that you will continue having negative EBITDAs up to 2022, what do you do? Instead of start thinking of actually selling, start lobbying with the government, because this is a distribution company, which is an independent distribution company, but working in an industry which is very delicate, because they deal with the public, with what you would call as a public good, electricity, meaning that there's also an issue of political risk. Politicians will come in to maybe manage the pricing so that the customers are not exploited. So you need to find ways of how you actually lobby the government on the cost of reducing the cost of energy, or maybe having a cost-effective tariff. Unfortunately, this country, even the people that came, couldn't even get the quantities of power that they sell and what tariff, because that was going to give me an understanding whether the tariff is within the industry norm. I couldn't do that. I didn't have that information. So these are the assumptions that were created. I used CAGR, which is basically the compounded annual growth rate. It's a very important principle that we normally use if you don't have any other information outside the trends or outside the information obtained in the audited financial statements. These were assigned audited financials for 2014, 2015, 2016, and 2017, which I used in the analysis. So here I had to come up with a proper plant and equipment movement. The aim basically was to first find what depreciation, the blended depreciation rate that I would use. After looking at the actuals, 3.3, 3.4, 3.6, we had to get the average, which in this case the average was 3.5. But this 3.5, I had to split it because I had two lines in the expenses. I had two lines on depreciation of plant and machinery and depreciation of PPE. So I had to actually split it based on the actuals. So I used the depreciation split, that this 4.4 would be split 80% to go to PM, to machinery, and the other 20% to go to property, plant and equipment. Same principle was actually used on the acquisition, I think, yes, on the CapEx acquisition, which was the average of the 2.3, 1.1, and 0.9. And you can see here, it's like there's no proper strategy on investment. But you would understand that a company that is having over 99% of its revenue going to cost of energy, they would be in a similar problem. There's no magic that they can actually do other than lobbying for lower cost of energy or increasing the tariff. The other cost systems, they are actually within range. So with all those, this is how their income statement was showing. Obviously, the first 3 years, you can see it's negative 26.5, 3.1, 24.5, which if you go to they are audited. These are the 24 and 31, 2017, 2016, 2021. 31, 26, and 24. So it shows that by end of 2022, there will be the losses will still be in the same range. I think about 31 billion naira. Some I'm selling myself because the currency, I hope this currency is in a number of countries in West Africa, so that you start fidgeting around and thinking which country is this. So let's move on. So this is the balance sheet, and you can see how this balance sheet is going. The value is actually being eroded on a yearly basis. You can see at least in 2017 it was at 103. It was, yeah, as you go this side you find that it's going to negative. But then who's going to allow this organization to go up to that level? Sorry. Sorry about that. So this is their cash flow statement. So sorry, let me get back. So by 2022, the balance sheet value will be in negative. So I don't know if this organization is going to continue existing, or the government is going to continue giving steroids for its existence. Really, I don't know. I just can't imagine that from 2021 to 2022, an organization in negative is going to continue surviving. And I even actually told the guys that I was helping out, I was saying, if you check, these are the actuals from 2016 to 2017, their equity is already negative. So the question that I'd ask and I'd pose to you as well is, then who owns this organization? Okay, I don't need an answer from you. Let's move on. So this is a cash flow statement. This is the summarized financials. And I recommend the organization doing these summarized financials. I think for those that are in equity research, they understand better why you have to come up with summarized financials. It becomes much easier to analyze and make better decisions. So you can see your revenue where it is. The EBITDA is already negative. EBITDA is basically like operating activities. That is the money that now you have to use for your capex and for free cash flows. But if it's negative, then there's a problem. Here it shows the EBIT, also negatives. Pre-tax profit and net profit are the same. What does it tell you? It tells you that this company, because it has been generating losses, they have no capability to pay tax. They cannot just pay tax because tax is based on profits. I'm sure corporate tax is based on profit from that country. So it's not possible. Then you have your cash flow from operations, which is already in the negatives. Yeah. So you go come the other side, you have your net capex. Free cash is in negatives. So it's a bit difficult. There's nothing really that they can do. Check on the changes in working capital. Coming to the balance sheet, I had already explained, but look at the net debt. That is after you remove your cash. This is what it is. Yeah. The financial ratios, they are all negatives. Depreciation as a percentage of sales, about 3 to 2%, which is fine. because depreciation as a percentage of revenue should not go beyond 7%. CapEx over sales, because it's just negatives. It's rough. It's rough. So what does it say? Then we had to create some visuals. Dashboard reporting is key, and it captures the insights of financial analysis. You can see where they are. The receivable days have deteriorated over time to over 338 days, meaning about 28 or 27 days short of the full year. So this you would understand because their prepaid customers are just about 4% of the total customers. So you can expect this here. And the residential customers, they're making over 60-65% of their total revenues is coming from residentials. So it should be a very big problem in collecting cash from residential customers. Yeah, some obviously there will be difficulties in just even accessing the owners, maybe their dogs and all these other things. Yes, so it's a bit tricky. It's extremely tricky. So you cannot disconnect because the houses are full of dogs. You cannot disconnect because they have gated communities. They just close their premises and you will not have access to reading the meat and whatsoever. So I can just imagine. I understand them. I review for them. Now look at this. I've never seen this before. I think even for companies that have adopted just in time, they can't have inventory issues about four days worth. Companies that have adopted just in time, at minimum, I think it's about 10 days. But look at what it is. What does this thing show you? One, it does show you that suppliers have stopped giving them the materials without demanding cash. So now it's more or less like on cash basis. Secondly, what risk is there? The risk is quite huge. In an event that the substation gets bent, there is a serious downtime on a particular machine. Then becomes difficult. You have to look around for money and maybe go to, again, the government, because I've seen the government grant there. Go to the government to ask for more funds just to restore the system. So it's quite huge. But why is it actually like this? One, because their receivables, they're taking over 338 days for them to actually get the money. Secondly, it is because of the trade payables. They are at over 800. From our forecast, where I was trying to be very modest in my working capital arrangement, very, very modest. Did we see the working capital thing? I must have had it. Then put it. So you can check on the operating margin. The lower this ratio is, the better it is for the organization. What it means is that the OPEX is higher than the sales. So how do you survive? How do you survive? And we know that a greater portion is coming from cost of sales. Ideally, this ratio is supposed to be maybe around 22 to 30%, but it's not like that. Free cash flows or negatives. So the question that I would pose to you, how do you turn this organization to a profitable entity? How would you? The cost of energy is 99.8% of sales. So what would be done? I'm waiting for an answer. So in the next part of my presentation, I will certainly show you what maybe can be done. Obviously, we'll play around on cost of sales, we'll play around on the revolvers, the concept of a revolver is like a credit line, where whenever you have a negative cash, it should actually trigger in and help you manage the crisis. So this is the workbook, the model that I developed using Kaga. Kaga is a very important principle concept that we should all follow. These are hard-coded because they're coming from the audited financials. Not cleaned up. This model, this part is not cleaned up because it's just the one that is, it's in detail. It's in detail. If I come here and show you this. This is cost of energy in 2016 against revenue. 99.8. So tell me what you would advise if it was in the exam. Don't say no, they reduce on cost, what. That will be very academic because in real life it doesn't work like that. So yeah, it's not things. So then now I had to come up with these formats. This is just formatted. These are the formats there. Yeah. It's quite an interesting thing, just analyzing these figures and seeing how a company is doing. So we have, if you check in here, there's nothing hard-coded. There's nothing hard-coded, meaning that the model is perfect. You can see what it is. Then we had to come up with the PPE schedule. This is what I'd already explained. This is where the average is getting thrown into here, and also throwing in which one, under depreciation. Then the working capital check on this working capital. From our forecast, we had to make it a bit more modest, showing that these guys have started paying. But maybe had we left it at 805 or somewhere there about, the negative that we have down on cash flows could have actually changed, because if you increase on trade payables, you increase on trade payables, you're actually indirectly releasing cash into the system. But at this level where they have reached, they have no option but just to start paying. Otherwise, this figure is going to go maybe to even about 1 or so, which becomes extremely dangerous. There should be some headroom in terms of the inventory that you have, the levels of inventory. Check I don't know what you can do to change these figures, but we'll try in my next presentation. I'll do it with you and show you what it is. These are the visuals that we created. So this is just a forecast, it's not a plan. So now what we'll be doing, maybe obviously I'll definitely prepare another video that will be looking at interventions that can be done, the lobbying that can be done to the major stakeholders, and how this company can continue being sustainable. We're going to have maybe a revolver, which will be part of maybe the government program, where we're saying whatever negatives that we get, there should be funds that should come in there. Whatever positives we get should first pay the revolver before it starts paying others. Then we're also going to bring in maybe an aspect of the interest charge. We'll say whenever a revolver kicks in, maybe there is an interest charge of 5 or 6% or 10%, depending on the interest rate prevailing. So building maybe scenarios on maybe the worst case scenario, and maybe the best case scenario, and see how it is going to look. The aim is just to try and see what would be the best position that would not really take out this company from the problem that they are facing, but maybe just to mitigate and for them to continue surviving, because the product they sell